Hi friends, in this video I am going to show you something very interesting. To be able to take some trades, we don't require to use much of backdated information. The present information which is current is sufficient for us to take some good trades. So this I am going to show you in this example. Okay, this is Bank Nifty 5-minute chart on 23rd January 2023. The market started with a powerful bearish candle. The wick of the candle is as long as the body of the candle. The price then tried to poke this low but failed and then has bounced back immediately. So this shows that there are some potential buyers in this zone. Okay. Now let us see if these buyers have real strength or not based on volumes. Okay. So as you see, price is increasing but volumes are decreasing, which means there's a divergence of volumes. Okay, so from this level to this level, okay, this is where one bearish candle has appeared. So from this level to this level, price is increasing and volumes are falling. And from here to here, a small minor move upward, price is again increasing and still volumes are falling. So which means this upward movement that is displayed here doesn't have enough power as it appears to be. That's the first signal. Now just for extra confirmation, I'm going to draw a little back downward. This is not essential, but that will be helpful. Okay, so in this chart, you can see that one major flow is coming from the bottom. Okay, this is the major flow, and to be more accurate, this is the flow. Okay, 1, 2, 3, 4, 5. It has 5 legs. Okay, let me draw that with the help of a path. Okay, this is not essential, but this is only acting as a sort of confirmation. So this is the point where you can start this low to A, B, C. Okay, it's not taking accurately. C, D, E, and F. Okay, so a typical Elliott wave will have 1, 2, 3, 4, 5 legs. So it is completing 5 legs in the upward move. And look at the major flow. As price is going up, this power of buyers is only decreasing. Okay, the volume, the length of buyers here is significantly reducing as price is going up, because that shows that the power of buyers is reducing at this zone. And now we are talking about very important point, that is the point where minor flow and major flow both are getting exhausted at the same point. Okay, so the major flow that is marked in red color, you see that price is exhausting at the red line. Let us draw a minor flow here. Okay, so this is the minor flow. Let me put that in blue color for you to understand better. So let me erase the major flow. Now you see that as major flow is exhausting, minor flow is also exhausting at the same point. Okay, and this last leg of that Elliott fifth wave move is not complete in its strength. That means it doesn't have enough power. So based on Elliott wave theory, based on the volumes and the price action that is happening all across, we see that this strength of this movement of buyers are not as strong as they appear to be. Now, price reached this level, created an inside bar, and then a frequency breakout has happened. Okay, so frequency breakout means the point where the tilt of market by buyers to sellers has happened. This is exactly precisely that point. So far, no candle slow has been broken until this candle has happened. So this is the fourth confirmation, frequency breakout. Now this should give us an immediate idea that we should short the market. Okay, so to do that, what we do, we draw a pitchfork. Okay, so to draw a pitchfork, we should be precise in our choosing ABC pivots. So I choose ABC because these are the pivots. Okay, price came from this bottom, touched this low, and then it turned back. So now you see that price is respecting the inward outward line of this pitchfork and creating some powerful selling pressure at the topic of the candle. And this is also the same point, or if you're talking about supply demand zones, this is also the same supply zone where price can turn back. Okay, so price is in that zone where a strong supply zone is created. Now we have 5 points converging at the same time. Let me repeat them once again. Major flow, minor flow, both exhausting at the same level. Elliott fifth wave completion. Volumes showing no strength of buyers and weakening power of buyers. 3. Fourth one, dynamic frequency breakout. Fifth one, price respecting the outward line of the pitchfork at the same point where the inward frequency is drawn and creating a powerful bearish bar. Okay, so these are good enough for us to enter a short trade. If you are to enter a short trade, the most accurate rate is when price hits this outward line of the pitchfork. In that way, you reduce your risk and dramatically increase your reward. Okay, but to be more accurate, take more calculated decision, you can wait for price to close below this candle and then see how again, if you have missed the opportunity here, see again how price hugged the same line and then created a fractal bar. So this is the signature, price signature that we have to observe when reading price. Now this is as simple as entering a short trade with 1:3 risk reward ratio. So far we have 5 points converging at the same point. Let us also bring in the concept of RSIs. Okay, so as price is increasing from high, RSI is going low, low. This third degree price divergence, bearish reversal divergence. So we have 6 techniques converging at the same point and then giving rise to a price fall signature. So here you could have entered a short trade, the very touch of this candle, or if not, when price closed below this low, you could have entered. If by any chance you miss the opportunity, this is the third opportunity. Okay, when price touches this low. So assuming that you take 1:3 risk reward ratio. Okay, short position. This is the precise point where you have entered the short trade. Okay, now this is the risk you have taken, and let us see the reward. So far price has given a reward of 1:2.5 and price is again coming back down. So there's a good possibility that price pokes below this low and then gives 1:3 risk reward ratio. So this is as simple as entering trades, guys. How wonderful it is if you know how to read the price like this. Now let me also give you another trade that you can assume based within this price flow based on what you call press zone. Press zone is that area where where market makers leave their footprints, showing that they have that's a precise point where they have tilted the market down. See, as price touched this inward frequency of this major flow up, okay, buyers try to show their strength, but there is significant push of price and then sudden fall of price from this point. So this zone we need to mark very high. Okay, so as price touched this zone after creating low here, when price touched this zone, these sellers, market makers have once again appeared very strongly. So that only gives us an indication that they are very strong in this zone back again. So when price again goes back this zone, we have a probability to short the market. We can short the market. Okay, so to think about a short trade idea, we can also draw a pitchfork in to see if there is any price exhaustion at that point. Okay, so you see that this pitchfork is beautifully being respected the price, and price reversal is happening more or less at the very midline of this pitchfork. So this is the kind of trade you have to assume, guys. And if you are going to short the market here, the risk is anywhere going to be this high. So again, we look forward 1:3 risk reward ratio, and this is the precise point you could have shorted the market, and this is the risk you can assume, and the reward as you go along should be somewhere around here. So tomorrow I'm expecting price to come down and touch somewhere at this level 42,700 odd. So this is how we have to trade, guys. And if you're interested to learn to read price like this in a professional manner, please do approach us. We could be of great help to you. Thank you so much. See you in another video. Bye bye.